All right, welcome to this video on the topics of bet and position sizing. If you haven't watched the previous video on risk management, please watch that first because this it's a segue into this video, right? And so there's a saying that many of you probably have heard, right? Compound interest is the eighth wonder of the world. If you really kind of harness the power of compounding, you can really, grow your wealth in very kind of extreme ways, right? This is how banks and bankers get extremely wealthy, right? Because they're just continuously compounding their capital. The trick is to, really limit the downside of compounding because compounding is inherently neutral, right? It's a double-edged sword. You can compound to the upside, also compound to the downside. The key is to maximize the upside compounding while minimize the downside compounding, right? To just give you an example, if done right, and you are, have a positive EV system and you trade successfully, I mean, you can really grow your money like in an exponential fashion, right? Just to put some numbers on it, 4 or 5 years ago, I was trading for like $50, $100 a day. Now I'm trading for like, $50,000 to $100,000 a day, right? So that type of kind of scaling is possible if done right. The key is you want to, if you don't really kind of master the concept of, bet sizing, position sizing, what happens is people fall victim to negative compounding. What does that mean? So you start out with $100, right? If you lose 20% of your capital, right, it takes negative 20%, right? In order to get back to 100, you have to generate 25% returns, right? $20 out of 100 is 25%, right? Uh, these examples get more extreme as your drawdowns get larger. So if you draw down from $100 to 50, which is a 50% drawdown, in order to get back up to 100, you have to generate returns of 100%. Does that make sense? If you draw down to 25, which is a negative 75% drawdown, in order to get back up to 100, you have to 4x your money, right? So the key is to minimize the downside so you're not fighting against this exponential function, right? So typically in my case, I don't like having equity drawdowns. Uh, Pretend this is my like equity curve, right? Uh, from the peak to the trough, I don't like having drawdowns of greater than 10%. I just want to grow my money consistently and steadily, right? I don't want my equity curve going like, crazy up and down, up and down. Because for me, day trading is a kind of cash flow type of business for me, right? Where it's generating relatively steady kind of income. I also dabble and I'm recently getting into like venture capital type investments, and that's kind of the high risk, high reward type of strategy, right? Especially in this kind of market where the entire venture capital space is pretty much dead at this point. I always want to have a fallback where I can continue to generate income, right? And that's what short-term trading is for me. So I don't want my drawdowns to be less than 10% because the larger the drawdown is, the more exponential the upside needs to be in order just to get back to square one. Does that make sense? So in order to control these type of drawdowns, you really need to calculate and really understand bet sizing. One of the huge red flags that you tend to hear on social media or you tend to see on social media is when these guys like double their money overnight, right? This guy maybe has like a $10,000 account and he makes like $10,000 in a day, and he's just like so happy posting on social media. So the first thing that comes to my mind and why it's a red flag is the we discussed this in the previous video on risk management, right? The noob trader approaches a trader investment from this kind of fantasy lane type of thinking where he only thinks about how much money he's going to make. A pro always comes from the approach of risk first. How much money you are risking first, and then reverse engineering the trade in order to estimate and calculate if the upside is worth the risk that you're taking, right? So in this case, where the guy's doubling his money overnight, the first thing that comes to my mind is how much risk did he take on in order to achieve those gains, right? Did he risk half his money in order to generate kind of 100% returns? From a risk reward perspective, a 2-to-1 risk reward in that case is still good. But what is he risking? He's risking, in that case, a downside drawdown of 50%. So if he lost that bet, he drew down to 50%. And because of that drawdown, he needs to generate 100% return just to get back to square one, right? You can't think from a perspective of survivorship bias where this guy doubled his money overnight. Because for every one person like that, there may be another guy who basically went broke or at least lost 50% of his money, right? And you don't want to, like I mentioned earlier, get in the way or like fight against negative compounding. So to segue from this point, we are going to get into a much more conservative and kind of systemized way of positioning and sizing your bets, right? So this is just a recap, an idea that we mentioned in the risk management video, right? It's not more so about the amount of money that you're putting into a stock or bet. It's more so about the amount of money that you're betting, right? Assuming a $10,000 account, you want to think from terms of risk first, right? If your risk is $100 risk, and your risk per share is $2, then by extension, you want to buy 50 shares to achieve a risk of $100 risk total. Does that make sense? And it doesn't matter if the share price is $1,000 or $50 per share. You are going to buy 50 shares regardless, assuming the risk is $2 in the same case, right? So in this case, if you're buying 50 shares, you are taking on a position size of $50,000. Whereas in this case, you are taking on a position size of $2,500, right? The absolute dollar terms of the position size is not important. What's important is the risk in dollar terms that you're taking and the risk per share that you're taking, right? And to get into more details on this, watch the risk management video. So this basically, to continue on what I was mentioning earlier, assuming a $10,000 account size, right? This is how a beginner, an intermediate, and an advanced trader sizes his bets. So, and we are thinking in terms of risk absolute dollar risk, right? Generally speaking, when you are starting out, you are a beginner, right? What this C quality, B quality, A quality is referring to is not all opportunities are rated the same, right? There are C quality setups where it's just like, it's like meh, right? B quality, it's pretty good, right? You want to bet more money on that. A quality setups are like the 10 times per month or whatever, 10 times out of 100 type of opportunities where you really have to like load the boat and try to capitalize on these opportunities, right? B quality setups may only like happen 30 out of 100 times. Normally speaking, the majority of kind of setups are like C and B quality setups, right? 60 out of 100, 30 out of 100. A quality setups maybe only happen rarely, right? Let's say 10% of the time. And what you really begin to see is what we mentioned earlier, which is this Pareto distribution, right? Where a lot of the money comes from the A quality setups, right? which only happens 10 out of 10% of the time. So a beginner, what he should do is risk only 1% of his money, regardless of the opportunity. In this case, if it's a $10,000 account, he's risking $100, right? That way, you need to lose 100 times in a row in order to really wipe out all your money, which, I mean, statistically is very, like, it's like pretty much impossible, right? The reason being is that in the beginning, when you're a noob, you don't even know what a C quality, B quality, A quality setup is. You don't know what distinguishes the difference between those kind of categories, right? Because you don't have the experience and you don't have the data to back that up. So you just want to basically, this is like the learning phase, right? Where you're just putting in a little bit of money, trying to get experience in the markets, right? Um, you like people mention that like 1% is like pretty low, right? It's like how am I going to grow my money if I'm only trying to make 1 or 2%? But like think of it like it doesn't take that much due to compound interest, right? Uh, it takes about 30 to 50 trades to really just double your money. And if you're day trading, that happens in like 2 or 3 months, right? If you do it right. All right, apologize. Had to pause the video for a second because there's some weird construction going around in the background. Anyways, to get back to the intermediary type of trader investor, right? This is where you've kind of had some experience, right? Kind of if you've done your tracking, your journaling, properly tracking your trades, which I'll do another video on in the future. You kind of get a sense of what qualifies as a C quality setup or a B quality setup or A quality setup, right? And so you want to begin shifting your risk from the C quality setup to the A quality setup. What that looks like is you may only risk 0.5% on the C quality setup, right? Which is like, I don't know, $50, assuming an account size of 10,000 and then you want to begin shifting your risk to the A quality setups, right? What that looks like from a kind of scaling perspective is a, a beginner is like linear, right? It's like there's no difference, right? C, B, A, it's like all the same, right? Intermediate, you're starting to scale up your linear, you're starting to scale your risk in a linear fashion, where the higher the quality, it's like you're allocating more risk to the higher quality setups, right? Now, where this is where we get to advanced kind of position sizing and betting sizing, right? This is where you've been, trading for like, at least 6 months, 12 months. So you have kind of a large sample set and large experience trading these type of strategies, and you're clearly able to distinguish between a C quality setup and a B quality setup and an A quality setup, right? This is where you begin to exponentially increase your risk. So what that means is you might not even play the C quality setups at all, right? Just bypass them. It's not even worth your time because you know that the vast majority of the opportunities and the capital to be made is in A plus setups. You may, for example, risk 0.5% on a B quality setup. And then so you shift all the risk and concentrate it in the A quality setup. So maybe you're risking like 5% on when an A quality setup comes along, which statistically speaking only happens 10 to 100% of the time, right? This is where you kind of start to achieve the Pareto distribution, where you're really hitting hard, loading the boat when the good opportunities come along, right? But in order to get to, if you actually do averages, maybe the risk per trade is still about like 1% a trade, but you're just concentrating it in the higher statistics, higher probability bets, right? To use a poker analogy, a C quality setup may be like, random like 10 jack offsuit, right? B quality setup may be like pocket queens. And the A quality setup is like pocket aces, right? Where you have a statistically higher chance of winning that hand if you encounter the opportunity. The trick is to basically be able to distinguish the difference between a pocket ace a pocket queen, and like a 10 jack offsuit, right? And it takes time and experience and proper journaling to be able to distinguish the difference between a C, B, and A quality setup. That's why in the beginning, everything is flat. You don't even know the difference between a C, B, and A, right? But over time, you want to go from flat to linear scaling to exponential risk scaling, right? And a large part of that is proper journaling and documentation. And how I still do it to this day, right? Where every day after the market closes, I record my trades, record kind of other data about my trading in a custom built kind of software that I coded up myself that basically analyzes my trades, right? That's kind of like why coding and software programming is like a superpower, because you can, automate and kind of make your life more efficient, right? And I'll make a video on the software and how I journal in another video. But this is a video on, basically betting and position sizing, which is a key part of money and risk management.